You buy a building with 12 units. Every apartment is rented. The tenants pay on time. On paper, you did everything right, and the math should be simple. 12 rent checks come in, 1 mortgage payment goes out, and the difference is yours. That's the story people tell themselves before they buy their first small apartment building. It's clean, it's intuitive, and it's almost never how it actually works. Here's the problem with that arithmetic. It only accounts for 2 numbers, rent and mortgage, when a working apartment building actually runs on somewhere between 8 and 12 separate financial pressures at once, most of which never show up in the listing photos or the sales pitch. Property taxes that get reassessed from moment you buy at a higher price than the previous owner paid. Insurance premiums that have risen sharply across much of the country in recent years, especially in markets exposed to storms, wildfire, or flooding. Water and sewer bills tied to a leak you can't see yet. A roof that's fine today and isn't fine in 18 months. None of that goes away because the units are occupied. In fact, occupancy is the thing that hides it best.
To understand why, you need one concept that almost nobody explains before people sign the loan documents: net operating income, or NOI. It sounds like jargon, but it's really just the honest version of the math the fantasy skipped. NOI is what's left of the rent after you pay every operating cost required to keep the building running. Taxes, insurance, repairs, management, utilities the landlord covers, vacancy losses, but before you've paid a single dollar toward the mortgage. Investors and lenders care about NOI more than almost any other number because it tells you what the building itself actually produces, independent of how it was financed. The mortgage payment comes after that, out of whatever NOI is left. And this is where a rule of thumb that circulates among real estate investors becomes useful, even though it's a simplification. Operating expenses on a residential rental property typically consume somewhere around half of the gross rent, before any debt payment is considered. Half. Not the 10 or 15% that a spreadsheet built purely around rent minus mortgage implicitly assumes. If a 12-unit building brings in $180,000 a year in rent, a realistic starting assumption is that roughly $90,000 of that disappears into taxes, insurance, maintenance, vacancy, and management before the mortgage is even in the conversation. Whatever's left has to cover the loan. If it doesn't, the building isn't an asset that month. It's a liability wearing an asset's clothing. This is the first real reveal, and it's the one that changes how everything else in this video should be understood. A fully rented building can still lose money every single month. Full occupancy proves that tenants exist. It says nothing about whether the rent they're paying covers what the building actually costs to run, plus what's owed on the loan. An owner can walk a building at 95% occupancy and be cash flow negative, quietly funding the shortfall out of personal savings, convinced that it's basically breaking even because the vacancy number looks healthy. The vacancy number is the wrong number to be watching. So if rent minus mortgage isn't the real equation, and occupancy isn't the real signal of health, what actually determines whether a small apartment building makes money? It comes down to a chain of decisions that mostly happen before closing, and a set of structural disadvantages that small buildings specifically run into. Disadvantages that don't apply the same way to a single rental house or to a 200-unit complex. Small multifamily properties, generally defined as buildings with somewhere between 2 and roughly 50 units, sit in an awkward middle zone. They're too large to qualify for the straightforward residential mortgages available to single-family investors, so owners end up in commercial-style lending. Shorter terms, often 5 to 10 years instead of 30, frequently with a large balloon payment due at the end, and a floating or periodically adjusting rate, rather than something locked in for the life of the loan. At the same time, they're too small to justify a full-time on-site management team or the economies of scale that make big apartment complexes efficient. You can't spread the cost of a maintenance crew or a leasing office across 12 units the way you can across 200. The result is a property that carries commercial financing risk while still requiring hands-on, almost personal-scale management. It gets the downside of both worlds and the full advantage of neither. That financing structure is worth sitting with for a moment because it's the hinge the entire risk profile turns on.
When you take out a commercial mortgage on a small apartment building, you are not locking in your cost of debt for 30 years the way a homeowner does. You're borrowing money for a fixed window, often 5, 7, or 10 years, with the expectation that you will either pay off the balance or refinance into a new loan before that window closes. During that window, the loan behaves exactly like the fantasy version: predictable payment, predictable math. At the end of the window, none of that is guaranteed anymore. You are re-entering the credit market as it exists on that future date, not the one you signed into.
That single structural fact is the mechanism behind almost every apartment building horror story you'll ever hear. And it's worth building out as a chain, because each link makes the next one more likely. It starts small. A property owner defers a repair, a roof, aging plumbing, an HVAC system nearing the end of its life, because cash flow is already thin and the building is fine for now. Deferring the repair doesn't make the underlying problem disappear. It lets it get worse and more expensive while quietly draining the owner's reserve fund on smaller stopgap fixes. With reserves thinner, the owner has less cushion when something unavoidable finally breaks, whether that's the deferred item finally failing or an unrelated shock like a spike in insurance premiums or a property tax reassessment. Thin reserves plus a real capital expense usually means missing or shorting a debt service payment or drawing down personal funds to cover it. And if that pattern coincides with the loan's fixed-term window closing, the point where refinancing is required, not optional, the owner is forced to refinance from a position of weakness, lower net operating income, a track record of late payments, and a lender pricing in more risk. The new loan, if it's approved at all, usually comes with a higher rate and tighter terms than the one it replaced. That, in turn, raises the debt service the building has to cover every month going forward, which squeezes cash flow further, which increases the odds of the next deferred repair. One weak link doesn't stay one weak link. It becomes the shape of the next 5 years.
This isn't a hypothetical chain. It's a documented pattern that played out across the entire small multifamily sector starting in 2022. And it's worth walking through as a real case study because it shows every link of that chain firing in sequence across thousands of buildings at once rather than just one. Between 2020 and 2022, financing was unusually cheap. A large volume of multifamily loans, including many on small buildings, were originated with interest rates in the 2 to 3% range, often as short-term, floating-rate bridge loans, meant to be refinanced within a few years once the property's income had grown. Buyers underwrote these deals assuming rents would keep climbing and that refinancing in 2 or 3 years would happen into a similarly favorable rate environment. That assumption held for a while. Then the Federal Reserve raised interest rates sharply through 2022 and 2023 to fight inflation, and the refinancing environment those buyers had planned around simply stopped existing.
By 2024 and into 2025, a large share of those loans reached their maturity dates and needed to be refinanced, but at rates that had roughly doubled, commonly landing in the 6 to 7% range instead of the 2 to 3% range the deal was underwritten on. At the same time, the capitalization rates investors used to value these properties expanded, meaning buyers were now willing to pay less for the same stream of income than they had been 2 years earlier. The combination was brutal in a specific mechanical way. Property values fell just as loan balances stayed exactly where they were, and monthly debt service on any new loan rose sharply, even as building income had only grown modestly, if at all. Industry data tracking these loans showed distress rates, a measure combining missed payments and loans flagged for special handling, climbing from roughly the 2 to 4% range in early 2024 into the double digits within about a year, with some segments of the market reporting distress above 12% by early 2025. Realized losses on apartment loans reportedly reached levels not seen since the aftermath of the 2008 financial crisis.
What that case study proves isn't that apartment buildings are a bad investment. It proves that the loan structure underneath a small apartment building is not a background detail. It's the single largest determinant of whether the same physical property generating the same rent turns out to be a good or a catastrophic investment. Two owners could hold identical 12-unit buildings on the same street, and the one who happened to lock in longer-term, fixed-rate debt would sail through 2023 and 2024 essentially unaffected, while the one whose loan matured in that window could be forced into a distressed sale, a foreclosure, or a painful cash infusion just to keep the lender at bay. The building didn't change, the financing did. The industry's response to this tells you what actually matters in this business, because it reveals what experienced operators focus on once the easy money assumptions are gone.
Lenders tightened underwriting standards, requiring larger cash reserves and more conservative income projections before approving loans. Buyers who were still active in the market began demanding steeper discounts on purchase price to compensate for the higher cost of debt, which is part of why property values fell even in markets where rents were still rising. And sophisticated owners shifted their attention almost entirely away from chasing rent growth and toward two much less glamorous levers: aggressively controlling operating expenses and building larger cash reserves specifically to survive a refinancing event, rather than assuming one more year of low rates. None of that is exciting. All of it is what actually separates the owners who kept their buildings from the ones who didn't.
That brings up the counterintuitive point worth sitting with, because it reframes what a small apartment building actually is. It looks like real estate, a physical, appreciating asset you can walk through and touch. Economically, it behaves much more like a leveraged small business with one product line and almost no diversification. A business with 12 customers, all of whom can, in theory, decide to leave, and whose entire revenue stream is pledged against a loan that has to be refinanced on a schedule you don't control. The rent roll is not the value. The value is whatever's left after operating costs and debt service, refinanced at whatever rate happens to exist on the date your loan happens to mature. That's a very different thing to own than a building full of paying tenants, even though from the sidewalk they look identical.
So, what does the honest comparison of outcomes actually look like? In the best case, an owner buys with a conservative amount of leverage, locks in financing with a longer fixed period, keeps meaningful cash reserves specifically earmarked for capital repairs rather than treating positive cash flow as spendable income, and benefits from steady rent growth and a manageable refinance whenever the loan term ends. That owner builds real, durable wealth, not primarily through monthly cash flow, which is often modest, but through the combination of loan paydown, appreciation over a long holding period, and tax advantages like depreciation that lower the effective cost of ownership along the way. In the realistic successful case, the path is bumpier: a slow year, an unexpected repair, a refinance at a somewhat higher rate. But reserves and conservative leverage absorb the shock, and the owner comes out the other side intact, if humbled. In the realistic negative case, thin reserves and aggressive leverage mean a single unexpected expense or a poorly timed refinance turns a profitable-looking property into a cash drain, forcing the owner to either inject personal capital indefinitely or sell at a loss into a weak market. And in the failure scenario, the one that played out for a meaningful share of owners between 2023 and 2025, the loan simply can't be refinanced on terms the property can support, and the building is lost to foreclosure or an emergency sale, often to a well-capitalized buyer who can pay cash or absorb the higher rate, purchasing at exactly the discount the previous owner's distress created.
Go back to the beginning of this video, to the picture of 12 rent checks coming in and one mortgage payment going out. That picture isn't false. It's just incomplete in the one place that determines everything. It treats the mortgage as fixed and permanent, when for most small apartment buildings, it's temporary and about to be renegotiated on a date the market controls, not the owner. It treats a full building as a healthy building, when full and profitable are two different conditions that can exist independently of each other. And it treats the rent roll as the source of value, when the real source of value is the spread between what a building earns after real operating costs and what its debt costs on whatever day that debt has to be refinanced. A small apartment building isn't a rent collection machine. It's a leveraged bet on your own discipline, on reserves you didn't spend, on repairs you didn't defer, and on financing you structured to survive a future you can't predict. The units are just where that bet happens to be standing.